Hey guys, so today we're going to be talking about one of my favorite books. And if you have any interest in investing or making money in the stock market, this is definitely a must-read. It is called The Intelligent Investor by Benjamin Graham. And for those of you who don't know, Benjamin Graham was a very famous investment manager and professor. He pretty much laid the foundation for what value investing is and how you can actually make long-term sustainable profits in the stock market. So, before we get into some of the most important concepts from this book, I do want to say that this is not a financial advice. So, please remember that when watching this video. But let's get straight into it. So, right at the beginning of the book, Graham lays out his philosophy on investing and how people should approach investing in general. And he says, the first rule of investing should be to protect your capital. That is to avoid the loss of principal. If you are out to double your money in a few years, you will probably end up with egg on your face. So right off the bat, Graham establishes that he believes investing is all about preserving capital and making sure that you don't lose money. So that means that you have to be really careful about the stocks that you pick, and you have to do your homework and make sure that you understand the business that you're getting into. Another thing that Graham talks about is the difference between investing and gambling. And he says the difference between the two is simple. Gambling involves the use of chance or luck. Investing does not. So in order to invest intelligently, you need to have knowledge about the company and the market. You need to have a plan going in, and you need to be able to execute on that plan. You also need to have realistic expectations and be patient. Graham also talks about something that he calls market, which is essentially the idea that the stock market is a manic pixie dream girl who is always fluctuating in price, sometimes high, sometimes low, sometimes in between. And it doesn't matter what you call it. But there is a constant fluctuation in the stock market, and sometimes these fluctuations can be really big and sometimes they can be really small. But they're always happening. And so what you have to do as an intelligent investor is learn how to deal with this ever-changing market and be able to take advantage of it. So, that means knowing when to buy and when to sell, and understanding the risks involved with each decision. And Graham also talks about the psychology of investing and how emotions can play a big role in whether or not you are successful. And he says, the most successful investors are those who can control their emotions and stick to their plan, no matter what the market is doing. This is something that I talk about all the time, especially in crypto where emotions run really high. And everyone is constantly trying to time the market. But timing the market is really difficult, and oftentimes it is better just to buy and hold, rather than try to time the market, because if you time it wrong, you could end up losing a lot of money. So that is why it is so important to have a plan and stick to it no matter what the market is doing. Another really important concept from this book is Graham's approach to analyzing a company. And he says that you need to look at both the quantitative and qualitative aspects of a business. So that means looking at the financial statements as well as understanding the competitive landscape and the management team. So when you're doing your research on a company, don't just look at the numbers. Try to understand the story behind the numbers and what they mean for the future of the company. Also, don't be afraid to think critically and question the assumptions that management is making. Just because they say that revenue is going to go up 20% next year doesn't mean that it will. You need to do your own research and make your own projections based on what you think will happen, and then compare those projections to what management is saying to see if they are in line, or if you think that they are being too optimistic or too pessimistic. And Graham also talks about the importance of having a margin of safety, and he says that you should always buy a stock at a price that is less than its intrinsic value. So that means that you need to have some buffer room in case your projections are wrong and the stock price goes down. So for example, let's say that you think that a stock is worth $100, but you buy it for $80 because you think that there is a good chance that the stock price could drop to $70. So in this scenario, even if the stock price drops to $70, you're still okay because you bought it for $80 and you were expecting that to happen. So, you have that margin of safety built in, and this is a really important concept to understand, because it helps you to avoid making big mistakes when you're reinvesting. Another thing that Graham talks about is the difference between active and passive investing. And he says that active investing can be profitable, but it's very difficult to do consistently. So basically, active investing is when you try to beat the market by picking individual stocks. And passive investing is when you just buy and hold a broad index fund. And Graham believed that passive investing was probably the best strategy for most people because it is very difficult to beat the market consistently. And if you're not able to beat the market, you're probably just better off buying and holding an index fund. Another really important concept from this book is Grant's approach to portfolio construction. And he says that you should always keep some cash on hand in case a good investment opportunity comes along. And he also recommends diversifying your portfolio across different industries and asset classes. So, for example, if you're investing in stocks, you might want to invest in a mix of large cap, mid cap, and small cap stocks as well as stocks from different industries. This helps to reduce risk and make sure that you are not too exposed to any one particular stock or industry. I also want to talk about something that Graham calls defensive investors versus enterprise investors. And he says that defensive investors are people who are primarily concerned with preserving their capital and making a little bit of money. And enterprise investors are people who are willing to take on more risk in order to make a higher return. And so Graham believed that most people were better off being defensive investors because it is just a safer way to invest. But if you're an experienced investor and you understand what you're doing, then you might want to be more of an enterprise investor. And finally, I want to talk about something that Graham calls Mr. Market again. And he says that you should always be on the lookout for bargains. So even if the overall market is overvalued, there are always going to be some stocks that are undervalued. So you just have to be patient and wait for those opportunities to come along. And when they do, you need to be prepared to strike quickly because those good deals don't last forever. If you like the sound of this book and you want to learn more about it, I highly recommend reading it. It is a really easy read and it is full of great information that can help you become a better investor. And if you're interested in learning more about investing, make sure to subscribe to my channel where I post videos about investing every single week. And if you enjoyed this video, make sure to hit the thumbs up button because that lets me know that you found it helpful. And yeah, that's all I got for this video. So, thank you guys so much for watching, and until next time, I hope you make lots of money.